Welcome to the video. Today we are breaking down why hoarding $75,000 in cash is a costly error for aggressive savers, especially young professionals with low expenses and minimal debt. We will walk through a fast-track plan to reallocate that idle capital into tax-advantaged accounts and high-growth strategies, while keeping a safe emergency buffer. Let's get into it. Here's our agenda. First, we will explain why excess cash becomes a drag on future wealth. Next, we will reveal a controversial but accelerated path to wealth. Then, we will convert that into a concrete, step-by-step plan you can follow. After that, we will highlight fee traps and how to avoid them. Finally, we will test your understanding with 2 quick quizzes and wrap up with key takeaways. Before we begin, a quick disclaimer. This video is for educational purposes only and does not constitute financial, tax, or investment advice. Your situation is unique. Please consult a licensed fiduciary or tax professional before making decisions. Let's frame the problem. Cash is safe and liquid, but when you keep too much of it sitting in a high-yield savings account, you lose to inflation and miss the exponential benefits of compounding. $75,000 idling is not neutral. It erodes purchasing power and postpones growth. Therefore, we need to right-size cash and aggressively deploy the excess. Here's a simple model of cash drag. When you hold excess cash in a high-yield savings account, inflation eats into the real value while the money fails to compound. Over time, that translates into a smaller future portfolio. The consequence is that you might need to retire later, raise your savings rate, or take more risk in the future to catch up. Liquidity matters, but only the right amount. This mind map lays out the accelerated path. First, slay the debt demon by setting aside a 3 to 6 month emergency fund and using excess high-yield savings to eliminate the $5,500 low-balance debt. Second, maximize tax-advantaged accounts. Capture the full employer match in the 401k, fully fund the Roth IRA early by front-loading from the savings, and then max the HYSA if eligible for the triple tax benefit. Third, lean into an aggressive allocation of 85 to 100% stocks through low-cost index funds, favoring broad market exposure, and limit fees by doing it yourself in an IRA rather than paying 0.3% to a robo-advisor. Fourth, build a lasting system by automating contributions, rebalancing annually, increasing contributions with raises, and maintaining your emergency fund. Finally, apply guardrails. Keep 3 to 6 months of cash, avoid high-interest debt, and revisit your risk level annually. Here is the action plan. First, calculate your emergency fund based on 3 to 6 months of essential expenses and keep that in cash. Next, use the remaining high-yield savings to eliminate the $5,500 debt. Then, front-load tax-advantaged accounts in order. Capture every dollar of the employer 401k match, fully fund the $7,000 Roth IRA for the tax year, and, if eligible, max the health savings account for the triple tax benefits. Finally, adopt an aggressive allocation of 85 to 100% stocks via low-cost index funds and automate contributions monthly. Here's a sample allocation for a 25-year-old with a long time horizon. The focus is on 85 to 100% stocks using low-cost total market funds across United States and international equities, with a small sleeve of bonds or treasury bills if you need psychological stability. Rebalance once a year to keep your targets intact as markets move. Let's compare fees. A typical robo-advisor charges around 0.3% annually, which buys convenience and automation, but reduces control over tax placement and asset selection. On the other hand, a do-it-yourself index fund approach often costs between 0.02 and 0.05% in expense ratios, granting full control and better tax efficiency. Over decades, the lower fee approach can save you thousands by reducing performance drag. This table illustrates how $75,000 could grow over 10 years under various return assumptions. At 2%, it becomes about $91,424. At 4%, about $111,018. At 7%, around $147,536. At 10%, roughly $194,531. The monthly gap versus the 10% scenario shows the opportunity cost spread across 120 months. These are hypothetical and not guarantees. Actual returns vary. Quiz time. Which contribution should you prioritize first when deploying excess cash? Option A. Maxing a taxable brokerage account. Option B. Capturing the full employer 401k match. Option C. Waiting for a market dip before investing. Option D. Buying individual speculative stocks. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is capturing the full employer 401k match. It is a guaranteed and immediate return on your contributions, and it should be prioritized before other investing steps. Second quiz. How large should your emergency fund typically be before going aggressive? Option A. 1 month of expenses. Option B. 3 to 6 months of essential expenses. Option C. 12 months of total income. Option D. No emergency fund needed if you invest aggressively. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 3 to 6 months of essential expenses. This buffer provides stability and prevents forced selling or taking on debt during an emergency while your investments compound over the long term. Here is a concise checklist you can screen capture. Compute your essential monthly spending and set aside 3 to 6 months. Use excess savings to pay off the $5,500 low balance debt. Capture the full 401k employer match immediately. Max out your Roth IRA contribution early in the year. If eligible, max the HYSA for triple tax benefits. Set an aggressive allocation using low-cost index funds. Automate contributions and rebalance annually. Finally, review your fees and consider switching from a robo-advisor to a do-it-yourself approach if you are comfortable. These are the most important points. Right-size your cash and avoid excess drag. Prioritize tax-advantaged accounts, starting with the employer match, then Roth IRA, and HYSA if eligible. With a long horizon, an aggressive allocation across low-cost index funds makes sense for many. Keep fees low by favoring do-it-yourself approaches. Finally, automate, rebalance annually, and review your risk periodically. To summarize, set aside a 3 to 6 month emergency fund and move excess cash out of savings. Eliminate small debts to free cash flow. Front-load tax-advantaged accounts by capturing the 401k match, funding the Roth IRA, and maximizing the HYSA if eligible. Choose an aggressive, low-cost allocation and automate everything. Then, stay the course for decades to let compounding do the heavy lifting. Thanks for watching. If this helped you rethink idle cash, please like the video, share it with someone who needs to hear it, and subscribe for more. Tell us in the comments what % of your portfolio is in stocks today, and what step you'll take this week to deploy excess cash.